Something unusual is happening in the silver market right now, and most people have no idea how big this shift really is. For decades, banks have played a central role in controlling, distributing, and profiting from silver, acting as middlemen between producers and the global market. But that structure is starting to crack, and recent changes are quietly pushing banks out of direct silver sales altogether. This is not just a technical adjustment or a boring regulatory update. This is a signal. When banks are no longer able or willing to sell silver the way they used to, it tells us something important about supply, risk, and what may be coming next. At the same time, a strange phrase has begun circulating among analysts and longtime precious metals investors: the $100 window. Not a prediction, not a promise, but a window of opportunity that many believe is starting to close. To understand why this matters, we need to zoom out and look at how silver has been priced, controlled, and suppressed for years, and why those mechanisms are now under pressure. Silver is not just another commodity. It is both an industrial metal and a monetary metal, which places it in a unique position. It is used in electronics, solar panels, medical equipment, and countless modern technologies. Yet it has also been money for thousands of years. That dual role creates constant tension between real physical demand and paper market pricing. For a long time, large financial institutions managed this tension by using paper contracts, derivatives, and futures markets to influence price without needing large amounts of physical silver to change hands. Banks could sell exposure to silver instead of silver itself, creating the illusion of abundance even when physical supplies were tightening. This system worked as long as confidence remained high and delivery was rarely demanded. But confidence is fragile, and once it begins to crack, the entire structure can unravel quickly. Recently, new rules, rising counterparty risk, and increasing physical demand have made silver trading far less attractive for banks. Holding silver now carries higher capital requirements, greater scrutiny, and more balance sheet risk. At the same time, industrial demand is surging, especially from green energy and advanced manufacturing, while mining supply struggles to keep up. This creates a dangerous mismatch between what the paper market claims exists and what can actually be delivered. When banks step back from selling silver, it reduces the supply of paper silver flooding the market, and that alone can have a powerful effect on price discovery. Less artificial supply means prices have to reflect reality more closely. This is where the idea of the $100 window comes in. For years, silver has traded at prices that many argue are far below its true value when adjusted for inflation, monetary expansion, and industrial demand. The argument is not that silver will magically jump to $100 overnight, but that there may be a limited period where physical silver is still available at prices that do not reflect future scarcity. Once banks fully retreat and industrial users begin competing directly with investors for limited supply, price behavior can change fast and violently. We have seen similar patterns before in other commodities. When financial players exit and physical demand takes control, the early stages always feel calm, almost boring, until suddenly they are not. Most people only pay attention after prices have already moved dramatically, when headlines turn sensational and availability disappears. By then, the window is gone. Right now, we are in the phase where signals are subtle, changes happen quietly, and only those watching closely notice what is unfolding. Understanding this moment is not about panic or hype, but about awareness. Knowing why banks are stepping back, how the silver market actually functions, and what structural shifts are taking place allows you to see beyond daily price charts and short-term noise. In the next part, we are going to look deeper into what it really means when banks are effectively banned or discouraged from selling silver, what rules and risks are driving this change, and why this could mark a turning point for the entire precious metals market. To understand why banks are stepping away from silver, we need to talk about regulation, risk, and something most people never hear about called balance sheet exposure. After the financial crises of the past decades, regulators around the world tightened the rules on what banks can hold, how they must value those assets, and how much capital they need to keep against potential losses. Precious metals, especially when tied to physical delivery obligations, are no longer treated as simple, low-risk assets. Silver in particular has become problematic because of its volatility and because physical supply can no longer be taken for granted. When a bank sells silver, whether directly or through structured products, it takes on the responsibility of delivery either explicitly or implicitly. As long as physical silver was abundant and demand was predictable, this was manageable. But today, that assumption is breaking down. Industrial users now rely on silver for critical technologies, and they cannot easily substitute it with something else. Solar panels, electric vehicles, data centers, medical devices, and advanced electronics all depend on silver's unique properties. This means industrial buyers are willing to pay more and secure long-term supply contracts, removing metal from the open market. At the same time, mining output has not kept pace. Many silver mines are actually byproducts of other metals like copper and zinc, which means silver supply cannot simply be ramped up in response to higher prices. This creates a structural bottleneck. Regulators see this imbalance and understand that banks exposed to silver could face sudden delivery failures or sharp price moves that threaten stability. As a result, banks are being pushed to reduce exposure, increase capital reserves, or exit certain activities entirely. In some jurisdictions, banks are effectively banned from selling physical silver to retail customers, while in others, the costs and risks make it unattractive. This does not happen with a press release or a dramatic announcement. It happens quietly, through rule changes, internal risk assessments, and strategic decisions. To the average person, it looks like nothing has changed, but beneath the surface, liquidity is drying up. Another key factor is the growing distrust in paper silver. For years, investors were content owning contracts, ETFs, or certificates that promised exposure to silver without requiring storage or delivery. But as stories of shortages, delays, and discrepancies have increased, more people are demanding physical metal. When too many holders ask for delivery at the same time, the system is tested. Banks know this. They know that being on the hook during a physical squeeze is one of the worst positions to be in. Walking away early is safer than being forced out later at a loss. This is why the idea of banks being banned from selling silver is both true and misleading. It is not always a legal ban. Often, it is a risk-based retreat. The effect, however, is the same. Less silver is available through traditional financial channels, and more pressure is placed on the physical market. When supply tightens in this way, prices do not move smoothly. They gap, spike, and overshoot. This is how markets reprice when years of suppression or artificial stability break down. The $100 number becomes relevant not as a prediction, but as a psychological marker. It represents a level where silver would no longer be dismissed as cheap or ignored as boring. At that point, it becomes a headline asset, attracting momentum-driven capital and public attention. But markets rarely give everyone a fair warning before that transition happens. The opportunity is almost always earlier, when interest is low and skepticism is high. That is why this phase matters so much. It is not about certainty, it is about probability and positioning. As banks retreat, other players step in. Industrial buyers secure supply, sovereign mints struggle with availability, premiums rise, and retail investors begin to notice that physical silver is harder to find and more expensive relative to spot prices. These are not random events. They are symptoms of a system adjusting to reality. In the next part, we will explore how silver has been historically undervalued, how inflation and currency expansion distort price perception, and why the gap between paper price and real-world value may be reaching a breaking point. To understand why many believe silver is dramatically undervalued, we have to step back and look at money itself. Over the last several decades, global currencies have been steadily devalued through inflation, debt expansion, and unprecedented monetary stimulus. Trillions of new units of currency have been created with the push of a button, while the supply of real, tangible assets like silver grows slowly and with great difficulty. When people look at the silver price today and compare it to historical levels, they often forget to adjust for how much purchasing power currencies have lost. If silver were priced today the way it was during previous monetary crises, adjusted for inflation and money supply growth, it would not be trading anywhere near current levels. This disconnect is one of the reasons the $100 figure keeps coming up in discussions. It is not arbitrary. It reflects a recalibration of value rather than speculation. Another way to see this imbalance is through the gold to silver ratio. Historically, this ratio hovered around levels that reflected natural abundance and monetary usage. In recent years, that ratio has been stretched to extremes, signaling that silver has lagged far behind gold despite having stronger industrial demand growth. Ratios like this do not stay distorted forever. When they correct, they often do so violently. Silver has a long history of explosive moves after long periods of suppression. It stays quiet, ignored, and frustrating for years, then suddenly moves in a way that shocks even seasoned investors. This behavior is partly due to its relatively small market size. Compared to gold, silver is a much thinner market, which means it takes less capital to move prices significantly once momentum shifts. That is both an opportunity and a risk. Small changes in demand or supply can have outsized effects. Inflation also plays a psychological role. Official numbers often understate how expensive life has become, but people feel it every day in housing, food, energy, and healthcare. When trust in currency weakens, even subtly, people begin looking for alternatives that cannot be printed or diluted. Silver fits that role, especially for those who find gold too expensive or inaccessible. This is where the idea of a closing window becomes very real. As prices rise, silver does not just become more expensive, it becomes harder to source. Dealers raise premiums, delivery times lengthen, and the cheapest options disappear first. By the time the price reflects scarcity, the metal itself is already spoken for. This is why those who understand silver do not wait for confirmation from the market. They look for structural signals instead. Banks retreating, industrial demand rising, mining supply constrained, and paper market stress are all signals pointing in the same direction. None of these guarantee a specific price target, but together, they suggest that the current pricing regime is unstable. Another overlooked factor is geopolitical risk. Supply chains are more fragile than they appear, and silver production is concentrated in a handful of regions. Political instability, environmental regulations, and energy costs can disrupt mining operations quickly. When supply is tight, even small disruptions can ripple through the market. This adds another layer of risk for banks, further discouraging their involvement. For individuals, however, this environment creates a different kind of consideration. It is not about trading silver day to day. It is about understanding its role as a hedge, a resource, and a form of financial insurance. The market does not reward patience immediately, but it often rewards it decisively. Many of the biggest moves in silver history occurred when participation was low and skepticism was high. By the time mainstream attention arrived, the opportunity had already shifted. The closing of the $100 window does not mean silver will stop being valuable after that level. It means the nature of the opportunity changes. Early stages are about accumulation and understanding. Later stages are about volatility, emotion, and crowd behavior. In the next part, we will explore what happens when this shift accelerates, how scarcity becomes visible to the public, and what lessons past silver spikes can teach us about what may lie ahead. When silver transitions from being quietly accumulated to being publicly scarce, the market psychology changes almost overnight. At first, the signs appear subtle. Dealers begin limiting quantities, premiums disconnect from spot prices, and delivery times stretch from days into weeks or even months. These frictions are often dismissed as logistical issues, but in reality they reflect stress beneath the surface. The paper price may still look calm, but the physical market is sending a different message. This divergence is critical because it reveals where true price discovery is happening. Historically, every major silver move has been preceded by a period where physical availability tightened while paper markets lagged behind. Eventually, the paper price is forced to catch up, and when it does, it rarely moves in a straight line. Past silver spikes offer important lessons. In each case, the run-up was fueled not just by inflation or speculation, but by a sudden awareness that silver was harder to obtain than expected. And once that realization spread, fear of missing out replaced apathy. People who had ignored silver for years suddenly wanted exposure, but the supply was already constrained. This created feedback loops where rising prices attracted more buyers, which in turn revealed even more scarcity. Banks and large institutions, having already stepped back, were no longer there to provide liquidity or dampen volatility. Without them, price swings became sharper and more unpredictable. This is why the withdrawal of banks matters so much. They have historically acted as shock absorbers in the market, using paper instruments to smooth price movements. When those instruments lose credibility or become too risky to deploy, volatility increases. For some, this is a threat. For others, it is confirmation that the market is finally responding to fundamentals. As scarcity becomes visible, narratives shift. Silver stops being discussed as a speculative trade and starts being framed as a strategic resource. Governments, corporations, and large manufacturers begin prioritizing supply security over cost. This changes buying behavior dramatically. Instead of purchasing on the open market, they seek long-term contracts or direct relationships with producers, further reducing available supply. Retail investors feel the impact last, but when they do, it is often intense. Shelves empty quickly, premiums spike, and the sense of urgency becomes self-reinforcing. The concept of a closing window is less about a specific dollar amount and more about accessibility. There is a point where owning physical silver is no longer a casual decision. It requires planning, higher capital outlay, and acceptance of volatility. That shift discourages new entrants and rewards those who acted earlier. This is not unique to silver. We have seen it in energy markets, rare earths, and even housing. Once scarcity is obvious, the rules change. Another important factor is trust. When markets function smoothly, trust is invisible. When it breaks, it becomes everything. If participants begin to question whether paper claims can be honored, they naturally gravitate toward physical ownership. Banks understand this dynamic better than anyone, which is why they avoid being caught in the middle when trust erodes. Their retreat is not a judgment on silver's lack of value, but on the increasing difficulty of managing its risks within the current financial system. For individuals watching this unfold, the challenge is psychological. It is easy to dismiss early warnings and wait for clarity, but clarity usually arrives alongside higher prices and reduced options. Awareness comes before validation. By the time silver dominates headlines, the market has already changed character. In the final part, we will bring all of this together, discuss what this moment represents for viewers, and explain why staying informed, patient, and engaged matters more now than ever. At this point, the picture should be much clearer. What is happening in the silver market is not the result of a single event, a rumor, or a short-term trend. It is the outcome of years of structural pressure building beneath the surface. Banks stepping back from selling silver, whether through regulation, risk management, or strategic retreat, are responding to realities that cannot be ignored anymore. Physical supply is tight, industrial demand is growing, and the traditional tools used to control price behavior are losing effectiveness. When those tools fail, markets revert to fundamentals, and fundamentals in silver point towards scarcity and repricing. The idea of the $100 window is not meant to create fear or urgency for its own sake. It is a way of framing a moment in time when silver is still accessible, still underestimated, and still largely ignored by the mainstream. Windows like this do not announce themselves loudly. They close quietly, then suddenly. One day the price still looks reasonable, availability still seems normal, and interest is muted. Then conditions shift, and looking back, it becomes obvious that the opportunity was in the calm before the move. This is how many major market transitions unfold. They reward those who pay attention early and penalize those who wait for consensus. For viewers, the most important takeaway is not a specific price target, but a mindset. Understanding silver means understanding patience, discipline, and the difference between noise and signal. Daily price fluctuations, headlines, and social media hype are distractions. Structural changes, like banks exiting a market, industrial users locking in supply, and physical shortages emerging, are signals. These signals suggest that silver's role in the global system is evolving. It is no longer just a commodity or a speculative asset. It is becoming a strategic material in a world facing energy transitions, technological expansion, and monetary uncertainty. None of this guarantees a smooth path or immediate results. Silver is famously volatile, and anyone involved must be comfortable with that reality. But volatility cuts both ways. It punishes impatience and rewards conviction. History shows that when silver moves, it tends to do so decisively, often leaving little time to react. By the time the crowd arrives, the easy part of the move is usually over. That is why awareness now matters more than excitement later. Staying informed, questioning official narratives, and understanding how markets actually function gives you an edge that most participants never develop. If you found this breakdown valuable, keep watching the related content suggested here, where we continue exploring shifts in the financial system, precious metals, and the forces shaping future markets. Make sure to subscribe to the channel so you don't miss upcoming analysis, because moments like this do not come often, and understanding them before they fully unfold can make all the difference.